the second quarter is officially in the bag, and the IPO market has slowed down. Well, we got to evaluate the new companies that have come public as part of the class of 2019 and also shine a light on what I've thought of them. All year I've been warning you, look, the IPO cycle tends to deteriorate the longer it goes on. Well, they start with the most enticing merchandise, and then they start bringing lower and lower quality deals as time goes on. So while the median stock in the class of 2019 is up nearly 9% from where a deal was priced, it's actually down 3.3% from its first trade. That's cautionary, people. Of course, there have been some huge winners. Beyond Meat, Shockwave Medical, Zoom Video, Cortexime, and Revolve Group have all more than doubled from where they came public. Beyond Meat's up 554% at the moment. And because we have accountability here on Mad Money, we want to review how we've done. So let's go over the IPOs that we've covered. There's 13 of them we got to kind of drill down on. First, this whole IPO cycle kicked off in March, when Levi Strauss & Company came public. I told you it was too expensive, and I'd only recommend it on pullback to 20. After trading sideways for a few months, wow, Levi's reported a quarter that the market didn't like last night, and the stock got obliterated, down 12% today. It's now under 21. Honestly, even under 20, I'm not even sure if I want to buy it after we heard from management last night. Second, there's the Lyft debacle. The rideshare company came public at the end of March, spiked dramatically at the opening, and then started going right back down. Lyft peaked at $88 on its first day. By mid-May, it had pulled back to $47, and while it's rebounded to $62 right now, well, it's still well off its highs from the day that it came public. I told you Lyft could be a good trade if you got it below 75, but the stock's strength at the opening suckered me into thinking that there was more demand for this thing than there really was. As Churchill might say, not my finest hour. In retrospect, I have a lot of concerns about the sustainability of the business and Lyft's slowing growth. There are better places to put your money. On April 4th, we got TradeWeb Markets. That's an electronic securities marketplace. The stock started strong, and I told you it was still cheap not long after it came public. Good call. TradeWeb has continued to climb higher. It's given us a 31% gain. I still like TradeWeb up here because it's a play on the continued digitization of trading. If you bought this one of my recommendation, I don't know, maybe ring the register on some, but you certainly got to let the rest ride because it looks a lot like market access, and that was one of the winners I told you about at the top of the show. Fourth is Pinterest. That's the social media network based on online vision boards. I told you Pinterest was worth buying if you get it in on the deal, but otherwise I said you might want to hold off. Now, this was a little too conservative as the stock racked up some nice early gains. Since then, though, it's been pretty sedate. A couple of months ago, we sat down with Ben Silbermann. He's the excellent CEO, and he told a very good story about how the company reported some earnings, really numbers that weren't as disappointing as Wall Street said, but, you know, it didn't matter. People thought the numbers were ugly. He's rightly in spending and heavily spending for the future, and that's really what went wrong here. I think it's worth owning, although I'd like it a lot more, of course, on a pullback. I have to admit that, boy, oh boy, do they send a lot of emails when you subscribe. Fifth, there's Zoom Video. That's the purveyor of cloud-based video conferencing software, which came public on the same day as Pinterest and ended up becoming one of the hottest deals of the year. This thing priced at 36. I thought it was okay. It opened at 65, though. It continued to roar up to 107 last month. We're finally pulling back to 92 and change as of today. Now, I was very worried about the valuation here from the get-go, which in retrospect was a big mistake. The market was desperate for something like Zoom, turbocharged revenue growth, genuine profitability. Still, Zoom sells for 33 times next year's sales, not earnings. I can't get behind anything that expensive. I'm afraid you'll get hurt. Cisco's got a competing product, which I think could get some traction here. Again, I reiterate, I was wrong about Zoom Video. It's been a rocket. I was too conservative, too bearish, too cautious about the stock of what is a very good company, and I hope they'll come on the show. Same goes for Beyond Meat, which we've talked about a lot. The maker of plant-based hamburgers changed the game when it came public a little over 2 months ago. While the gains here have been spectacular, especially since Beyond Meat reported a blowout quarter in June, the stock's valuation is simply bananas, people. I know I've been too cautious about this one, too, but discipline should always trump conviction in this business, and my discipline tells me that Beyond Meat is a cult stock, a cult stock. That's way, way too hot for us to touch. Plus, my wife says they taste terrible. I like them as long as they're smothered in condiments. Its valuation is impossible to understand, at least until its rival, Impossible Burger, comes public. How about Uber? Another big one that came public with a whimper. After the Lyft debacle, we were worried about Uber, but while the stock initially got hit, it quickly bottomed. Lately, the performance has been pretty decent. This thing's up 21% from its lows. Unlike Lyft, Uber actually reported a solid quarter right out of the gate. I'm warming up to this one again, but I want to see another good quarter before I'm ready to really say, you know what, Uber's for real. The service is for real. Don't know about the stock yet. Next, on May 17th, Luckin Coffee. That's the upstart Chinese coffee chain. Came public, and it spiked from 17 to 25 before pulling back to 20. I told you to be very afraid when it was up in the 20s because the company was growing too fast for its own good. Given that the stock quickly plunged to 13, now that was a good call, although it's since rebounded to just under 19 as of today. Nah, still don't like it. More recently, we've gotten a bunch of good ones that haven't changed very much. A little over a month ago, Revolve Group came public. This is the online fashion retailer. It's been a terrific performer, opening at 25 and running to 37 today. When it was at 36, I told you to wait for a pullback, and while the stock quickly surged to 48, it just as quickly gave back those gains, and you could have gotten in for $31. That's why we say wait for a pullback. Now, once again, I'm going to tell you wait for a pullback before you pull the trigger. You're getting these kinds of erratic trading in these unseasoned stocks. You'll be able to get a chance in Revolve. In mid-June, CrowdStrike came public. This is a cloud-oriented cybersecurity company that had an explosive IPO, with the stock surging from 34 to 63.50 right out of the gate. And it kept climbing. On June 19th, when CrowdStrike was at 77, I told you it was too hot to handle. I like Zscaler more. With the stock down $74, that was the right call. CrowdStrike is selling for more than 25 times next year's not earnings, but sales. It's too rich for me. Good company. Nosebleed stock. 2 days later, Chewy came public, and this is the online pet food retailer that everybody I know as a pet uses, including us. This is another one that came public with a bang. I told you it was worth buying when it dipped below 30, but so far it hasn't gone below 30 and change. This is a great company, but a pricey stock, weird ownership structure. It's at 33 now, and it doesn't look like it'll run away from us. So I say keep your bat on your shoulder, wait for a better pitch. 3 weeks ago, Slack Technology started trading. They did what's known as a direct listing rather than IPO. And since then, it's been moving sideways in the mid-30s, kind of doing nothing. While people are very excited about the collaboration software play, I like the software. It's just another super expensive stock. Still, I told you it was worth buying under 40 in this crazy market. I'm standing by that judgment. Finally, one I'm very intrigued by. 2 weeks ago, we got the Real. That's the actual name, Real, which surged from 20 to under 29 on its first day. If you remember, this is that online consignment store that's growing like a weed, sans Roundup. Compared to many other recent deals, the Real has a reasonable valuation, selling for roughly 7 times sales, still expensive, but 49% growth rate. Kind of reminds me of Etsy. You know, I like Etsy. I told you it's worth buying on a pullback to $22.50 or less. We're still about $4 from that level. I say be patient, but I understand if you want to pull the trigger. Why? Because it is a really good company. Bottom line, with many of these recent IPOs, you feel like an idiot for being disciplined. Yes, I feel like an idiot when it comes to Zoom or Beyond Meat. They've made a killing for you. That was meant if you were willing to forget or forgive traditional valuation metrics. And I'm not. I know it's frustrating. Maybe you'll never get a viable pullback in some of these names, but you need to realize that sooner or later there will be a correction in the class of 2019. Sell. And when that happens, I want you to keep your composure, focus on your favorite names, and be selective so you can view the sell-off as a buying opportunity, not a calamity. Robert in Florida. Robert.
Hey, Jim. Greetings from sunny Florida.
How are you doing?
Good. My question is about Tufin Software. Went public a few months ago. I got in at 22. The company has very good revenues but still loses money. And I want to know if it's time to take profits or buy more.
It has got every single buzzword. It's got cloud. It's got firewall migration, data center migration. It's a really red-hot stock. It's another stock that's losing a lot of money. Company's losing a lot of money. I got a ton of them that are like this. You know what? Actually, I prefer Okta. Yes, Cramer family fave Okta to Tufin. Some of these IPOs made you killing. What a market. Now, look, if you get a sell-off, keep your composure and buy some of your favorite names. I just told you where the prices are good. Many of the companies are excellent. Stocks are too high. Much more mad money ahead. Good news if the dog ate your homework. I did it for you, and it can make you some money. Then does the wear and tear in Levi's stock leave you with the blues? I'm eyeing the stock after today's hideous drop. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.